Today's panel will discuss the changes to the insurance industry, excuse me, and to see how the established ways of doing business have changed and how they may change going forward. So on today's panel, to my far left, we have Aditya Dutt. He's the president of Renaissance Underwriting Managers Limited and a senior VP of RenaissanceRe Holdings Limited. Aditya oversees Renaissance Underwriting Managers Limited and RenaissanceRe Ventures Limited. He was appointed to the company executive committee in 2010. He's responsible for structuring and managing RenRe's catastrophe joint ventures, including DaVinci and Top Layer Re. Directly next to Aditya's right is Bill Pollett, who's the CEO of Blue Capital and was instrumental in its founding and its launch in 2012. He joined Montpelier, Blue Capital's parent company, in February 2006 and has been responsible for developing and managing third-party capital since. And next to me is Guy Swayne. Guy joined Nephila in 2013 as a principal focusing on risk origination, working with established and new counterparties who are seeking protection from nat cat and weather exposures. So, the further biographies are in the presentation if you, in the handout. But anyway, let's get started here. I'll start with Aditya, and each one of your companies employs a different sort of or different structured third-party capital platform. So, I guess everyone might have their own view of that, but could you discuss your platform and then also how you see it versus the way the rest of us may see it, and also its strengths and weaknesses?
Yeah, thank you, Gary, and thanks for coming by today. I think I'll focus on three things that differentiate us rather than get into a detailed description, but I'd boil it down to three main qualities. Number one, our size. So we offer 10 billion plus of capacity to the reinsurance market on an annual basis. So size is very important, as I think Jeff said in the last panel, but it's not the only thing that matters. The second thing I'd say about us is housing rated and unrated balance sheets under the same management structure. And I'll get to that later, but it's really about giving the clients choice. And third, hopefully we'll talk about this as well, but aligning our interests with our partners, whether they're private shareholders or public shareholders or hedge funds or whatever the investor may happen to be, but aligning our interests. I think we take all of those things very seriously, but I'd say if we were to differentiate, those would be the three things we would focus on at RenRe.
Thank you. Bill?
Okay, well, thank you, Gary. In some ways, or many ways, I guess, the Blue Capital structure is similar to Ren. Ren have been in the business for a long time. They're recognized as a leader. Montpelier Re is also recognized as a leader in the property cat space and other reinsurance and insurance lines. And really, Blue Capital is just an extension of that. Montpelier Re has been trading with third-party investors for 10 years now. We did our first trade back in 2004. And really what we've done over the last number of years is sort of formalize that structure with the asset management platform. I think some of the key, maybe differentiators that we offer are, one, flexibility. We can source business through a rated balance sheet or through collateralized reinsurance, reinsurer Blue Water Re. We have the ability to do funds of one, special purpose accounts, commingled accounts, all sorts of different flavors from a risk and return perspective for investors that are looking to participate. Clearly, but leveraging off the franchise, the expertise that we've built over that 13-year period, and providing. And I think one of the key advantages in this market is providing access through that affiliation with Montpelier Re, access to pretty well the entire market of business that's traded, rather than just sort of trading in some of the smaller segments of the marketplace.
Thank you. Okay.
Thanks, Gary. To some degree, Nephila covers aspects of both my colleagues to my left. One difference is that we have one constituent. We have a single investor base. We don't have a rated balance sheet. We borrow that. So is it an advantage? I don't know, but it certainly means we're focused on one pool of investors, and that's all we do. So we don't get distracted by having a different balance sheet that may be equity-backed. We don't just get distracted by colleagues on my right, the rating agencies, and similar. So being able to just focus on one thing, and we think try and do it as best as we can, we think that gives us an advantage. By having the one constituent, Actually, we have 10 billion as well, very similar size. We think that is a big statement in the market. It allows us to be very flexible and really allows us to listen to our counterparties, the insurance companies that we trade with, what their needs are, and be flexible and offer big capacity as needed. So I think, we sort of complement each other pretty well.
Okay, thank you. Aditya, I'd like to follow up on the one thing you mentioned. One of your strengths is the underwriting process, but given your platform includes Da Vinci, Upsilon, and Top Layer Re, how do you get your investors comfortable with the potential conflicts of interest, and how do you also maintain your desired returns?
So I think you hit on the right topic here, which is we prefer to call it alignment of interest rather than conflict of interest.
I'll rephrase that. How do you get investors comfortable with your alignment of interest?
So, and Jay mentioned it. Part of it is having the tenure in the business to understand what it is long-term partnership means, what they want, and kind of growing with your investor base. I think Nephila has done this very capably. But the cornerstone of aligning interests, in our opinion, is your investors should follow your fortunes in some way, shape, or form. And that's what alignment really means, is I shouldn't profit disproportionately or be on the opposite side of a trade with someone I'm calling a partner. Now, there are situations when we go out and purchase retrocessional coverage or transact in a way that it is a counterparty, but our long-term vehicles are clearly built on aligning our economic interests with our partners. And how do you do that? Well, you can co-invest. So we can put money alongside our partners so that they feel we have skin in the game. So we've never done a transaction or sponsored a vehicle where we haven't put money in, every single one. Often we're the largest investor alongside our partners. So I think that's one way to show it. Another way to show it is to take the risk side by side with your partners. So if a client comes to us and says, I need $10 of insurance, we'll take 5, and the sponsored vehicle takes 5. So in my view, at least, it's very simple to align interests. It's have economic skin in the game. And I think Jay Cohen touched on this, we think when you stop having that, it does, not that it's bad or good, it's just a different way of thinking about your customer, your client. And when you retain risk, as we've seen in other financial markets like the banking market, the mortgage market, retaining risk makes you act differently as opposed to sending it all out the door. So are you in the moving business or the storage business?
Right. Okay, thank you. Now, Bill, just people like an ease of doing business, and one of the views is that there's more than one, at least at Blue Capital, there's more than one contact point for customers. Now, does that present a challenge for you and for the provider versus having a single contact, and do you expect to change this going forward? And also, how do your investors view you as a publicly traded closed-end fund format? Does that limit the people that would come into your space, into your company, excuse me?
Okay, well, thanks, Gary. There's a number of different questions there. First of all, in terms of facing the client, our cedents, the insurance companies who we sell protection to, I mean, it's nothing new to have more than one paper. If you're a global reinsurance group, you often have different rated papers around the group. We have a Lloyd's business, which is also potentially selling product to the same clients, the Montpelier in Bermuda. So it's just an extension there. I mean, we see it as a huge benefit to be able to go into our clients and sell them collateralized protection through Blue Water Re, in addition to the rated protection, if they're looking for that product. And one of the most gratifying things for me over the last 3 years, having built this business out with the group, is that we were concerned initially that Blue Water Re would be perceived as a competitor within the building, and actually 3 years later, they very much the Montpelier underwriters, the traditional underwriters, see it very much as a benefit because they can go into their clients with other products, so it helps them grow out their overall relationship. In terms of the closed-end fund in the UK and the managed company in the US, I mean, I think that's a little bit different in terms of distribution. It's certainly not the only business that we're in. We find that pool of capital very, very attractive because it's permanent. And I think for the type of client that we're looking to sell that protection to, that permanency is of value. There's no redemption risk. It's going to be there, long term, which is very, very helpful. We're also not spending an inordinate amount of time convincing investors to stay in because they can't get out. But I mean, there's definitely benefits to that permanent capital. It's only, the intention is that over time that'll be just, I mean, it'd be a core part of the business, but it'll be only one part of the business, and we have more than one commingled sort of open-ended fund, and then we have the ability to do separate accounts as well. So, I think it's just, it's an interesting pool of capital, but it's...
Okay, thank you. And Guy, just a question. Nephila was founded in 1997 and subsequently reestablished or established as Nephila Advisors in 2010. You've been around almost 17 years now, excuse me. What have you seen, changes have you seen in the market? What kind of lessons have you learned through the years? And if you could project a few years forward, where do you think you might see Nephila? Because you clearly, I think, still somewhat different than the colleagues to the left.
Well, what have we learned over the 17 years? I think one of the things my partners that have been in Nephila a lot longer, a couple of them from the onset, is you never stop learning, you never stop listening. And I think one of the key things that we have done over our 16, 17 years is continue to evolve, continue to see what's going on in the marketplace, where the need is in the marketplace. 17 years ago, Frank and Greg, who started Nephila, small fund, the two of them, their first entrance was cat bonds. The second one was retrocessional business. Very easy access, you don't need a lot of resource, you can participate very, very easily. But it's a limited market, and it's a very volatile market. Certainly the retrocessional market is in our view. So over the years, as we've developed an understanding of the marketplace, developed an understanding of our investors' appetite, one of the drivers has been to get much better granular data understanding of the underlying risk. So the better the understanding of underlying risk, the odds would be that you can price that risk better and therefore have a more certain return. So that is what we've continued to do and reinvest in the business. And as we are today, we're close to 70 people, spending a lot of time understanding analytics, researching the market to see where the new opportunities arise. And in the last 3-4 years, we spend a lot of time looking at, in the property cat space, which is the only arena we play in, is what we call unmet demand, where there's pockets of risk that should be in our market that's being held by governments around the world. And I think that is what our evolution has brought us to today's position, is looking at trying to entice more risk into the market where obviously we want to play, but the market in general can participate, both competitors as well as the broking world benefit from that.
And okay, thank you. Bill, I'd like to address the next question to you. Clearly, again, so much has been discussed about the influx of new and alternative capital into the reinsurance space. Warren Buffett has said there's a natural progression to good ideas, to good new ideas how good ideas go wrong, excuse me. The progression is the 3 I's. First there are the innovators, then the imitators, and then the idiots. And I'm not meaning to call anyone any names, just quoting Mr. Buffett. Okay,
is that so. Three of us here?
No.
Good.
So, what do you see out there? I mean, because there's just been so much capital that's come into this space. I mean, we can go back a few years. There was so much money that went into certain structured finance products, and everyone thought they had it figured out until they didn't. So, so we all saw what happened back in 2007, 8, and 9. What do you see out there that's causing you, or potentially to worry that either the new capital out there just doesn't get it? I mean, other panels they've addressed, they don't see them as the new investors as naive, and I don't think they are. But it's clearly a very complicated business, and just having a lot of money is not sufficient. So do you think there's things out there that they're not getting, certain risks, either those providing the capital or those who are investing the capital aren't getting, because reinsurance is a business where experience does matter. We all learn lessons over time, and you just can't get it out of a book.
I mean, yes, so there's a lot of interest, a lot of capital coming in. I think in general, most of the investors in this space are very sophisticated. A lot of them have been around for a number of times. Firms like Nephila have been spending a decade and more educating investors. In general, the principals or the managers of that capital are very experienced and professional with a good underwriting background. You know, and the investor gets to choose, you know, which philosophy he wants to go with. Are there areas that are alarming? I mean, I guess on the margin, there's some capital flushing into some newer funds, and I need to be very careful here because I don't want to say anything off court, but some of the quota share vehicles, I think, are maybe areas of capital that you need to be very concerned about from a reinsurance buyer's perspective. You need to realize that some of that capital may not be there longer term. Now, when we're building our partnerships, we're looking for partnerships that understand the risk, that are looking to participate over the longer term, that are not looking just to trade in and out, and that might get a big surprise. But I think in general, that is the case. Whether the investors in those type of vehicles, you know, understand the risk and the risk profile, you know, only time will tell. But you know, in general, that's just a very small piece of the overall pie. And I think, you know, investors are there. They've got their eyes open. They've got a lot of professionals helping them make those right decisions. And you know, I think it will continue.
Guy?
I was just telling you about when I started in the industry, I was underwriting in Lloyd's for an agency that was very much the old-fashioned names agency. And I would say a lot of those investors weren't the smartest people or on the block or understood the risk they were taking. But I think, I mean, Warren Buffett's comments can be aligned to any industry. And I would say that right now there's some very, very smart money coming in, very smart people indeed. And there's probably some, I think idiots is a stronger word, but less smart. And vice versa. There's been some people in the industry for a long time that, you know, personal view, may not be as smart as the people that are coming in now. So I think it's vice versa.
So just, I know there was a follow-up on that. There was a catastrophe bond that triggered back in, I think, 2011. It was a thunderstorm bond, and that ended up going to litigation due to one of the investors. Is that something that if you're a buyer of reinsurance, that would you consider that a one-off? Because really the cat bond market, for all it's, you know, it's been around, say, since '98 in any substance, there've only been a very limited number of events that have triggered bonds. So, but if you were, say you were a buyer of the protection, do you think that's something that is not considered, that people are going to, you know, the capital markets investor is going to try and find the little hole rather than just paying up the money right away?
I think one of the clear things as a, if you buy a, or if you're a seller of a bond, is ultimately it's a public instrument. You don't know who's holding that bond at the time of the loss. So you run the risk of somebody holding that bond, the event happens, and they challenge it. You know, you can't stop that. I mean, the one thing I would say, I mean, I can't remember the exact specifics of that bond, but, you know, sadly our industry is been fairly fraught with arbitrations, disputes over the years. It's nothing new. You know, as an industry, we try every year to tighten up policy language and coverages, but at the end of the day, if it comes down to willingness to pay. And if somebody decides they're not willing to pay a loss, then that's their stance. But it's certainly a valid concern that I think any reinsurance buyer should weigh up when considering a cat bond versus a traditional reinsurance or a collateralized reinsurance.
So you think it's fair to say that the people coming in realize if you want to start playing in this space, your willingness to pay should be established, that essentially you can close down the, you know, I shouldn't say close down the market, that's too strong, but impact the growth of the alternative capital if they don't have that willingness to pay, because the reinsurance industry, the traditional industry, if you will, has shown the willingness to pay. Is that fair?
I think that's fair, and I think, you know, we participate in cat bonds, and we would apply the same reinsurance principles.
Right.
We understand the risk, and if the claim happens, we're ready to pay.
Sorry, go ahead.
No, I was going to say, I mean, but it does play, I think, to the strength of the traditional reinsurers. We've got the relationship, we've got the track record. You know, for certain types of clients, where, you know, it's very important that they do get paid the claim very quickly, and that it's very important that the limit reinstates so they can trade forward. You know, so it's a different type of buyer, purchasing different types of products, and I think the key thing is to make sure they go in with their eyes open. But I would say, you know, I would say that many buyers of insurance protection are concerned about that exact fact. You know, are they going to end up in courts? Are they going to get paid their claims? You know, is it going to be a sort of normal transaction where they get their claim repaid?
And Aditya, just if you could, on that question as well, if you know what you view as the risk, you know, and because clearly you, RenaissanceRe has a very strong underwriting process, which lends a lot of strength to the market. So,
yeah, on the investor point, I can only speak from personal experience, not from others, but we've encountered excellent investors who really test us, who ask us great questions, who put us through the paces. So some of them might be here today. But we feel like we've been tested pretty thoroughly by the people that come and invest with us. So actually, I've yet to come across someone who's in the third category, to be honest with you. Now, I think we as an industry, 2 points, tend to ask ourselves, we talk a lot about third-party capital and what if. One of the things that has not happened in our business is a test of the capital and a test of willingness, a test of fortitude from a financial perspective, or ability to stay in the market. That has not happened. And I think once it happens, we'll have a much better roadmap of who's doing what. So I think that's in a loss. Warren Buffett has another great quote, which is, "You have no idea who's swimming naked until the tide goes." So we don't. And the fact is, we've had 9 years of no major event in the United States, which is the peak zone of the world. So we just don't know. And I think we'll discover a lot of the answers to a lot of the questions we're asking once that happens. Willingness to pay is a very interesting concept that we even debated. It's the reason people buy insurance. I don't know how you stay in business if that's even questioned. If you go into McDonald's and say, "I don't know if they're going to sell me a burger," why would you go there? I think to me, that's a very odd question that is even being asked of the industry, that of course you should have the willingness to pay. For underwriting for us is in some ways, a very straightforward exercise. Claims paying has to be excellent. You have to pay a valid claim quickly. Your customer cannot suffer because you want to hold the money back. And you have to be fair to your shareholders in charging an acceptable return at the front end. That is underwriting. And so to us, it's fairly straightforward. And it doesn't matter which capital base you do it for. And it doesn't matter who your investor is. That's kind of the responsibility you've been trusted with, is please give my money out at an acceptable rate of return and treat me right and pay the claim when I need to. I think it's actually our job to explain that to the investor, not the investor's job to figure that out. Willingness to pay is something we should explain to our investors. Look, this is how it works. This is how we pay a claim. It shouldn't be their job to figure it out and after the fact. So again, that's just my opinion, but I think we owe that to our partners.
And just for the record, that cap on that did trigger was the investor who did bring the suit and ended up losing, was dismissed.
Lost. Yeah.
So yeah, a couple of years and a lot of money later he lost.
Right.
Okay, the next question, just want to, again, focusing on all the capital coming into the market, and there are so many players, so many new players, if you will, and I think on a previous panel they discussed size, size matters. But back in the 1980s and 90s, there were more than 40 primary dealers with the Fed. Today we're looking at around 22, either between mergers, bankruptcies, whatever. We're down to a significantly less number. So if you look at the space out there today, how many companies do you think do we really need to be out there, and to keep this from being viewed as a commodity? Because at some point in time, when you have 50, 60, 100 vehicles out there, whatever, people are going to say, what is the difference? How do you differentiate yourself? And as a follow-up to that question, I think, we generally, as technologies come around, we all become, we're reliant on the computers, and this is clearly a heavily model-driven business. So at what point, again, what do you think can happen to the industry that keeps the expertise in there and keeps it from, Guy, I'd like to start with you first, please.
Okay, a few
couple questions in there.
questions in there. Well, let's start off, maybe a little different view, but it's possible that cat risk is a commodity, I think, and I think You know, the same way of, you know, you get oil, which is a commodity bringing it out of the ground. It's a very complicated commodity. You've got to find it, you've got to get it out, you've got to refine it, you've got to sell it on. You know, if you view cat risk as a commodity, you know, relationships are very important. Understanding your client's important. But you're still selling that unit of cat risk. And ultimately, you know, one could argue the winner is the person that brings that cat risk to the market in the most efficient manner. You know, we all have different business models, but in our own way, I think we're all doing that adequately and perfectly well. You know, I think I heard Jay sitting here saying he was surprised there hadn't been more M&A in the last recent years, and you know, one would think that could be part of the future because, you know, I think certainly in our space, in the property cat arena, which is all we focus on, is, you know, having the ability to offer significant capacity, size, does matter, is a differentiator, allows us to sell a better product to our counterparties, which benefits our investors. So I do think that is a, you know, I think it should be viewed as a commodity. And I think in some aspects, if it's not viewed as a commodity, that just brings added complexity and added cost to the product and to the transactions. Moving, probably missed out a point, but moving to the model aspect, I'm not sure we really have a view. I mean, the industry uses, again, vendor models for an assessment of risk, but we, like a lot of people, have built our own proprietary models to enable us to get a better understanding and view of risk. And I think really, you know, it's just the only segment of the industry that perhaps blindly just follows the vendor models would be the cat bond sector. But I think, you know, we have proprietary models. We understand what's good about the vendor models, where they're deficient, and we have to fill in the gaps and get comfortable with using our tools to make the correct decisions.
Thank you. Aditya, if I did turn that question to you, please.
You know, I think we had other experts on M&A, so I'll stay away from that topic. You know, yeah, I think you can easily make the argument that fragmented industries should consolidate. And so, you know, if that's a generic argument that ought to be made in the reinsurance business, so be it. I will say, you know, I think it'd be useful for us to talk about the new capital, you know, kind of in a way that Guy expressed it, which is, can we make the pie bigger? I think that's really what's important and incumbent upon us as an industry to do is, how do we get this capital in a form that our customer values it? And so whether that's 10 people offering that or 40, actually, I don't see that as a relevant measure of the industry. It's how many people are actually delivering to their customer what they need. I don't believe that's a commodity. I don't think managing risk is a commodity. And providing solid risk advice and capital options that back up that risk advice is a commodity. That's skill. That's learning how to work with your client, trying to solve their problem. That, I believe, is very, very difficult to just say, well, you know, I can just rent a model and 4 guys and I can do this. So we don't buy that argument necessarily. We think, you know, the largest clients in the world are trying to, and the smallest clients are trying to solve, to them, extremely complex problems of how do I transfer risk in the most efficient form possible, and how do I get cost-effective coverage with the best financial security, and I can do that in a simple fashion without a lot of frictional cost. And you know, I think it should be our job to say, how do we get this capital to flow in a way that's uninterrupted and gets to the end part so that people buy more insurance. And absolutely, you know, that's what to me that's what matters. Not if there are 10 people doing it or 40 or 100. If we can actually accomplish that, great. There should be 200 people doing it. Well, don't quote me on that.
Too late.
We're fine with 40 right
now. Waiver. And Bill.
Yeah, so no, I'd like to also take, you know, issue with, or just have a different view from what Guy's expressed. But you know, we're coming at it from a different part of the market as well, right? So we don't believe that size is everything. You the type of clients that we're focused on are the smaller mutual privately owned insurance companies who maybe buy 100 million, 200 million limit per event versus 2 billion plus. Sure, those 2 billion plus nationwide globals like to buy big chunks, but the smaller guys, it doesn't matter if you're a 20 billion balance sheet or a 2 billion balance sheet, they're never going to buy more than 10% or 5% of their program from one reinsurer. So they're looking for diversification across their panels, especially if they're taking credit risk, which they are with the rated carriers, clearly. So, and that's one thing we did learn from, I think all risk managers learned from 2008, is that it's better to have 10 A-rated, reinsurers than one quadruple A, right? So, I think there is room for many different players. I mean, maybe not the 40 or the 60 that you were referring to earlier, but certainly a number of different players to allow the clients to diversify. That's what we're hearing from our clients anyway. They're looking for that diversification. Secondly, in terms of commodity, I think when you go into some of the peak zones and you write some of the products, some of the maybe more derivative-based products, or the products that that embrace a big percentage of the market share in a particular zone, they might be commoditized. But I think when you get into more complex risks in more regional areas with, the skill is understanding the underlying risk and investing in that process. And I think that there's a huge ability here within this marketplace to differentiate your portfolio by investing in that expertise. So,
okay. At this point, if anyone has any questions, get a microphone out there to anybody.
My question is about supply. You guys are all, to some extent over time, in the money-raising business. You're raising funds for your vehicles. But you can only raise the amount of money that you can use, presumably. The question is there a lot more money that you could raise that you couldn't use? How much is on the sidelines? If you opened up your funds, everyone come on in and give us the money, could you raise 3x what you have? I'm not sure how you can answer it, but if you can give us some color on that.
I could start. Jay, I think it's a function of the market. As I said, the investors are smart. They read what's happening, and if you started writing positive equity research reports, we could probably raise a lot more. But all kidding aside, I think it's a function of the market, and I think all of us would say if the market afforded it and the capacity could be deployed at a rate of return that we're all happy with, sky's the limit. It could be double, it could be triple, but I think we're all trying to be prudent that if we can't put it to work, we won't go out and ask for it. And so it really, I think, is a function of the market. As of today, you might say that the incremental demand's another 10 billion, I don't know. And if it was a better market, the incremental demand could be 100. Again, I'm just trying to put a quantification, a ballpark on it, but I think it is a function of what we're all seeing out there. And
yeah, I'd agree with that. I think, speaking from Nephila, we grew quite significantly in the last 3-4 years because we saw the opportunity to put that capital to use in, wind pools in the States, enticing more buying there, Citizens, California, etc. Right now, it's not as obvious that need for more capital is there in the market. But totally agree. If we could see that need, certainly believe that there is capital sitting there, interested by the returns they see in this somewhat uncorrelating sector.
Okay. No, I'd echo those. Clearly, Jay, you've got to be very careful. We're in this business for the long term. Your reputation is everything. We've got to be very careful about execution. And you can only take so much in. And it's really deciding where that's going to come in with and with whom.
Thank you. Any other questions?
We've been talking to policymakers a lot the last year or so about expanding markets both in the developed world and the developing world. Policymakers are skeptical. So it's almost like you need a stunt. You need the NFIP report from Carpenter to be published, which says that there's 8 to 12 billion to take out flood risk out of the NFIP. You need $10 billion in Florida to completely replace the Florida Cat Fund, or you need to replicate the CEA in California in a voluntary market pool. So things like that are things, I mean, that would actually change a policymaker's perspective. Is that something that might be possible?
I hope so. I mean, I think that's it. I mean, you mentioned it earlier, you know, our job is to bring solutions to the market, to bring products, I won't say commodity, products to the market to entice more buying, bring more effective capital to the solution. You're absolutely right. You know, the big opportunities in the last few years have been significant changes in attitude or changes in tolerance on governments retaining that risk. Right now, it's, we'd love to find the next one, and that's what we spend an awful lot of our time doing, talking, listening, traveling the world, trying to identify that next opportunity where we can, help the market grow. But right now, there's nothing obvious out there. Obviously, the flood program is certainly talked about a lot. Yet to see what really happens. And that's not just a US phenomenon. I think flood is pretty much a global issue for the insurance industry that's really not dealt with very well at all. Part of that is understanding the risk. Part of that is the models associated or lack of understanding. But certainly there is an opportunity there. Right now it's hard to tell whether that's next year or 10 years' time. And that's really one of the challenges, especially when you're dealing with governments, as you well know. It's not an overnight decision or change of practice.
It does happen, though. I mean, citizens for years didn't, never purchased reinsurance, and in the last few years, it started not just purchasing reinsurance, but from non-traditional sources, cat bond, pool re in the United Kingdom, NFIP, as you know. So, we're hopeful that as the awareness of the product goes up, and you're involved in a lot of these discussions, but that as the awareness goes up, the risk that's currently held captive by various state-owned enterprises reaches the private market. We're certainly proponents of that.
And just in the past couple, I think 3 times, the World Bank essentially, or Fondin, has sponsored catastrophe bonds covering either earthquake and or hurricane risk in Mexico, and they actually might do a recovery because of was it Hurricane Odile. One of the bonds may have actually triggered about a 50%. We have the bond on watch negative, so I'll leave it at that. We'll see what the reports say. But so government, government organizations are starting to recognize there is a risk, and there've been we've heard of other discussions covering non-traditional areas. I think the Caribbean has a fund now. There's been some bonds issued covering that type of risk, and so we think that is something that will be seen over the next few years because there is a large amount of risk out there. Are there any other questions? And actually, I'll just follow up on that and kind of leads back to going back to the commodity question is, as a way, going forward as, getting away from the Florida risk or the California quake risk, do you see like the market moving towards covering things such as like climate change or more potentially terrorism risk, cyber risk? Is that something that you think would be, is something in the offing, or is it just too difficult to try and ascertain the risks related to that for either yourselves or your investors? So,
okay. Well, I mean, our view on that, I mean, that's an area, if you're talking about it from an RLS fund or collateralized reinsurance perspective, where a rated balance sheet has so much advantage in terms of being able to write those business, which is very, very complicated. So, we don't see it as an area that Blue Water Re would look to develop product. We do occasionally get an investor coming in that says they would like to take a share of a book that we have in our company on a quota share basis, where there's an alignment of interest and they want to, and that's something we would definitely look to do, although it would tend to be during a time when we were looking to grow that business rather than shrink the business. And a lot of those businesses you just mentioned are ones that, the rate environment isn't particularly attractive from our perspective at this point. So we're not necessarily looking to grow them. But
yeah, I mean, some of those lines you mentioned are already in the market. Terror is sold on a standalone basis and included. Cyber is still sold on a standalone basis and included. So yeah, I think I agree with Bill's comments that the rated carriers who can lever their capital a little bit more than a collateralized carrier are better homes for that risk, because they try to construct diversified portfolios that gives them the greatest advantage. So, yeah, absolutely, we see it happening. Some of that risk ought to stay with the cedent, but it's coming to the market, right. And our job is to look at it and price it, and hopefully.
As you said earlier, we saw with either Target or Home Depot,
yeah,
the risks that are there, and if the idea is you want to get out to the customer, I guess it's something maybe on the rated balance sheet you're going to have to potentially start offering in greater amounts. Do you think, or is it just too unknown?
At this point,
cyber risk.
Yeah, at this point it's unknown. Cyber is one of those things that's, past experience actually doesn't tell you very much at all, right. Because the technology is changing, while you're underwriting it. So yeah, it's too early to tell, I would say, at this point.
I think also, those totally agree with both comments, but both those areas right now are very small in terms of volume. And that's the benefit of having a leveraged balance sheet. You can, assuming one has the expertise, and one should have the expertise to underwrite any risk, you can take that in its infancy or in moderation and use the leverage on the balance sheet, whereas in a fund structure, it's less attractive and less obvious that there's a need to put capital to work there.
Thank you. Now, I'd like to address the next question to you. Is, as we said, with the levered balance sheet, gives you greater flexibility to price certain risks. And I was at a presentation a few weeks ago where the manager of an ILS fund told his investors, hey, you've had a good few years, we've been making low double-digit returns, and that's all good and well, but going forward for the next 2-3 years, expect 4 to 5%. So, if I'm an investor, if I'm looking to put capital into this market, diversification of risk is a good thing to have, and I think with a pension fund with 0.5%, 1% kind of makes sense. But overall, how do you view this market going forward? And do you think this could wash out certain players who've come to this and said, listen, it's just 4 or 5% isn't enough? And how do they compete with the levered balance sheets?
I did think it was an interesting, having read your question, that there's a manager that's thinking I can make 12 points last year and now I can only make 4 to 5 this year. If that's, I don't think our market's changed quite as much as that. I think my colleagues here would agree. So slightly, I would say, odd comment unless the business model is changing dramatically. I think leverage balance sheet and peak risk are the two things to focus on there. We clearly know and we focus on peak risk, and that still remains our number one goal. Leverage works to a point if you can find diversifying risk to offset that peak risk. But I don't think, take a Cat 5 in Miami, there's not enough marine business until I saw that boat out there. That might change my view.
What boat?
Yeah. It's dark.
See a big white thing.
Exactly. But there's not, to an event of that size, there's not enough marine or aviation or other lines of business to truly diversify. So at that point, diversification falls down. I think we certainly feel that having an unlevered balance sheet take that peak risk, providing that peak risk is in itself diversifying to the capital base, makes total sense. And we still see that. That's still, again, although it's not obvious out there, we still think there's the opportunity to get more purchase from the peak zone areas. So I think it's not as obvious it was 2-3 years ago, but that there is still opportunity.
Thank you. And I did.
I'm not sure if that answered your question or not, but
I did. Thank you. And since you gentlemen have both, unrated and rated balance sheets and collateralized, what do you view this? How do you view this?
Well, I don't think they're mutually exclusive. Again, we try to come at it from the client perspective, which is client wants choice, right? And so it's not what do we have and you ought to buy what I have. It's actually what does the client want? And if the customer is better served with rated security in a reinstatable form, fine. We should be able to give it to them. And if they would rather have collateralized money in a vault, we should give that to them. So we try not to lead the witness in that respect. They can choose what they like. So I don't think it's mutually exclusive. What we do say to our customer is balance sheets are homes a risk, and some homes are more efficient than others. So if the problem you're trying to solve is a particular one, X, the best place for that risk is here, and another one could be somewhere else. It's not all risk shouldn't go to one home, and so we don't see it as mutually exclusive that one's better than the other. It's actually what does the client want? And as we've clearly seen in the last few years, clients have gravitated towards constructing a bouquet of security that includes traditional and non-traditional. I think it's a positive, not a negative.
No, I agree. Just to clarify, I think this industry and the press loves to put it in a competition, traditional versus non-traditional. At the end of the day, it's, we've got to provide, the solutions and the products that our buyers want, and whether that's, rated balance sheet, collateralized, bond form, that's their decision. We just need to be able to offer those product offerings, which, frankly, all three of us do. And that's the key.
No, just to pick up on your comment about that return coming down, may well be that they've repositioned the portfolio. I mean, it's all relative. So I mean, if you're comparing 5% versus an investment grade bond portfolio, it might look all right. It just depends on the risk of that portfolio and your view of that risk within the portfolio. In terms of, and that's part of the education process, to educate ourselves as to what the investor's looking for, and to educate the investor as to how to think about that risk and the construction of the portfolio to meet their objectives. The rated versus the collateralized, I mean, I suppose in just the 2 years that we've been up and running as a collateralized reinsurance vehicle, there's been quite a significant shift in rates in some of those collateralized products. And I think, being able to have access to a rated balance sheet gives you flexibility to reposition those investments outside of the hottest areas. I mean, if you're an ILS fund that's just focused on one particular pocket, and that pocket is impacted by by an over demand for it, clearly spreads come in, there's a decoupling, then you're in a tight spot potentially. Again, and I think that's one of the advantages that the three of us have, is we have different ways to source the risk and to structure it. And the bottom line is that in our funds, we're effectively creating hybrid rated reinsurance companies by leveraging the rated balance sheet that we partner with, right? So there's different ways of constructing the portfolio. So it gets a lot more complex when you start thinking about all the different variables and variations, but that's what we're there to do, and we have the tools to do it.
Thank you. I'd like to just ask the audience if there are any questions right now, because I have one more prepared question. So, okay. Great, so just go for the last one. And again, just another investor, another manager of a fund was telling me one of the issues his clients have raised to him, the people he provides the insurance for, let me put it that way, was one of the advantages or perceived advantages of the traditional market was the reinstatement. And what he has been told was simply, look, I have a good year, you have a good year, good year, good year, and then all of a sudden I make a claim and the cost of my reinstatement is just skyrockets. Essentially, I'm almost self-insuring. That's the view he made. May or not be true, but that's correct, 100%, but that's what he said. What do you think that advantage is still there, or that the traditional reinsurance market provides, or where the ability to reinstatement, or is just too expensive an option, and people are just going to say, look, I'll go with the one-year policy, and whatever happens, happens, and leave it at that. So, because you do both, so.
Yeah, beauty's in the eye of the beholder. Yeah. A customer who wants the second event protection will prefer the reinstatable product. Again, we just don't have a preference. It's what does the client want.
Do you see more companies more people who want insurance going that way?
Yeah, I think just if you were to objectively look at the reinsurance market today, it does gravitate towards the reinstatable product. Okay. That is the large majority of reinsurance purchasing that takes place today. The foundation, at least, of the CAT program is constructed with the reinstatable product. Someone who's buying billions of dollars of reinsurance doesn't say, I'll start with a CAT bond. Or they generally start with large layers of reinstatable coverage. But that's just an objective truth. That's not, we don't celebrate that fact that it works that way. It does. And people do that because they might have their own rating constraints. They might have their own capital efficiency problems that they're trying to solve. So again, it's just what the reality is. It's not what we want or don't want.
So I'd maybe answer that a little bit different. I mean, I think the reinstatement is of huge value to the insurance companies, the smaller insurance companies out there that don't have other options. So again, you can't paint all of their clients with the same brush. There are some that have lots of options. They've got massive capital. They've got access to capital markets. They view reinsurance really as an arb in a year, and they can swap it around the next year if they need to. Whereas some of the smaller private companies, can't trade forward after an event unless they've got a program that reinstates. So different value proposition. I think that that's very powerful, and I think that that's why the rated reinsurers just have a huge advantage for the majority of the business out there. Now there's also spots where collateralized reinsurance works very nicely, and at the same time the client's looking for diversification away from that that rated balance sheet and where there is systemic risk out in the tail. So if they can put in 10 or 20 or 30% maybe on the outside of collateralized protection to diversify that risk, that's a great thing. But it's more difficult to structure it to work for the investors. Yeah. It's much less efficient in most cases.
I mean, again, it goes back. It's really up to the buyer as to what his choice is. I mean, we've been offering reinstated limits for 12, 13 years. We're agnostic to whether it's reinstatable or via our fronting arrangements or collateralized. It goes back to the person buying, quite rightly, if he's got a big balance sheet, he's probably going to get more comfortable with cat bond or single shot collateralized versus the smaller company with a smaller balance sheet that probably can't sustain as much risk as the bigger guy is going to, I think, definitely err towards the side of reinstatable limits. But I think it's our opportunity. It's our, going back to your point, we should be offering that buyer the range of products, and he should choose what fits his business model.
But do you think the alternative the new sources of capital that are coming in here would be willing to offer reinstatements in any meaningful way, or is it just you think the investors like okay, I put my money in, and I suffered a loss. Okay, I don't want to double down, or would the premium offset make it worthwhile?
The basic economics are very hard to make. So where you're selling a second limit of protection without getting any upfront economics, make it difficult to do so I effectively be collateralizing both limits, only getting one premium. It's obviously the structures around that that you can create, but that basic form is difficult to do in most cases on a collateralized basis. But there are other ways around that. You can sell second event protections separately if you want to, or so I think one of the things that has happened over the last couple of years, and it's really accelerated over the last 18 months maybe, is the innovation in our industry. And what's happening is that the different collateralized platforms are bringing innovations to the market that are really making the traditional underwriters think and work much harder. And in our shop, we call them the green underwriters because Montpelier Re's corporate color is green, are working much, much harder to find solutions that work for their clients rather than selling the same product they've been selling for the last 10 years. And that's great for our clients, right? That's what it's all about at the end of the day.
Just one last question, and whoever chooses to answer. How much do relationships still matter in this business, or is it going to be price-driven, do you think? Because relationships have been a driving factor in doing business. Do you think it's going to be more economics going forward, or?
I think relationships, the question I think we should ask is, what is the relationship built on? Yeah. Not just relationships writ large. If it's built on, I've been a good advisor to you, my client, and I've tried to do the right thing for you, and that doesn't mean I was necessarily cheap. I gave you the right advice.
And I paid your claim quickly.
And I paid your claim quickly. I delivered on my promise, right? Effectively, insurance is a promise. And so, yeah, I think we deeply believe that those relationships are the strongest. If the relationship is built on price, then I think you've got a problem. But we think, ultimately people do business with people. not institutions, and relationships do matter.
Yeah, I think relationship is a huge part of our industry, exactly that. You know, the ability to sit around the table and discuss, you know, if there is a disagreement, you discuss it, you know, as opposed to the alternative. But relationships, I think, only last if you're delivering the product to the counterparty. And, you know, some of the counterparties, I think, in the last few years have got far more sophisticated in their buying habits, how they evaluate the cost of transferring risk to our market. So we need to keep up with that advancement in their thinking. So it's a double. I mean, relationship, nice people, that's great, but relationship, which, going back to your point, is being able to discuss on the wavelength, design products, collateralized products that are answering a problem that company has. It's a double relationship.
Bill, one last comment? Or?
No, I mean, I totally agree. I mean, it just depends on the client, but I think relationships are critical for most.
Okay. I'd like to ask the audience if there are any questions one last time. Otherwise, let's give a round of applause for our panelists here. Thank you.